Most people would agree that tax planning is a smart idea. But those same people might also think it sounds like a lot of work, and boring work at that, so they generally choose to avoid it. Skip the planning and you may miss out on the chance to grow your wealth. Plus, you could end up paying more in taxes than you should. Being able to avoid that double whammy to your finances makes tax planning sound a lot more interesting. It's pretty straightforward if you think of tax planning as having a life cycle with 3 phases spread out over your investing journey: save more, invest and grow, and distribute. Let's break that down. In the first phase, you could have more money to invest if you save money on your taxes. To do this, you need to know the basics, like the difference between tax deductions and tax credits, and how capital gains are taxed versus your ordinary income. That way, you can claim every write-off you're entitled to and pay at the correct tax rate. Otherwise, you could end up not just paying your fair share, but overpaying. And a basic knowledge can help you avoid making simple and all too common filing mistakes. Things like underreporting income, claiming deductions you don't have documentation for, such as childcare or charitable donations, not having enough tax withheld throughout the year, or paying your taxes late. Those can all trigger a red flag with the IRS and can result in costly IRS penalties. Next, you invest intending to grow your money. Part of a comprehensive tax plan is to select the appropriate types of accounts for your individual circumstances to help maximize your long-term wealth. By using tax-advantaged accounts, you can have some control over when you pay the tax. For instance, with a tax-deferred account, like a 401k or a traditional IRA, you generally fund the account with pre-tax dollars. That means you typically don't pay taxes on what you contribute or on the earnings, only when you begin making withdrawals. Not paying taxes up front can leave you with more dollars to invest. Alternatively, Roth accounts, such as a Roth IRA or a Roth 401k, are after-tax accounts, meaning your contributions are made with dollars that have already been taxed. The assets in these accounts grow tax-free, and if you follow the rules, you don't pay any tax on future qualified withdrawals. In some cases, paying the taxes up front could offer tax benefits later, during the distribution phase. Maximizing contributions to tax-advantaged accounts is a big part of the growth phases, but your taxable brokerage accounts can also be tax-efficient, depending on your investment selection, the timing of your asset sales, and your individual tax circumstances. For some investors, municipal bonds and ETFs can be smart choices in a brokerage account. And holding your investments for more than 1 year qualifies them to be taxed at the much lower long-term capital gains rate. Sell them in 1 year or less, and they are considered a short-term gain and taxed at your ordinary income rate. Tax planning is still important when you reach the distribute phase and start taking money out. By creating a tax-efficient distribution plan, you can take withdrawals in a way designed to help your savings last longer, while possibly minimizing the impact of taxes on Social Security benefits and potentially avoiding higher Medicare premiums, which are based on income. If one of your goals is to gift a portion of your wealth, strategies like gifting during your lifetime and potentially setting up trusts can help ensure your assets are used the way you intend. A comprehensive tax plan may also help minimize estate taxes and maximize your charitable giving. In the end, the tax planning life cycle is a guide to use at every stage to help postpone certain taxes, avoid unnecessary taxes, and maximize your after-tax wealth.